All right, so today we're going to learn about infinite banking. Has anybody written an infinite banking concept policy before?
Never. I've
Never.
seen it been done.
I've seen it in I know you have. This is very informal. If at any time you have questions, don't raise your hand. Just please unmute yourself and just jump in and ask. All right, everybody should be invited to the speaker stage so you can unmute. And if you have your cameras on and you're decent, then please turn your cameras on so we can see your pretty faces. Infinite banking, what is this? First of all, infinite banking is not a product, it's a process. And if you missed the first screen, I left it up on that forever. But first of all, this is not a new concept. This has been going on for hundreds of years. It was more so made famous by the Rockefellers. They called it their waterfall method. And then Nelson Nash wrote this book, Becoming Your Own Banker. And when that book came out, it was like a new idea people hadn't heard of yet. And he called it BYOB, or Becoming Your Own Banker. And that's kind of when infinite banking was sort of born, if you will. So it's not a product, though. You will hear me say all the time, like an IUL versus an IBC. IBC, to me, usually is when you're using a dividend-paying whole life insurance policy. You can do infinite banking with an IUL. It's just not the best idea. So does anybody want to guess why it's not the best idea? Because I hear TikTokers all the time going, you can be your own bank. Listen, I admit it. I've made those videos. I've got an ad running right now. I use that ad simply because I'm talking about infinite banking. At the end, I'll lead them to an IUL. I use that video simply because it had 2 million views in 2 days. So it obviously performed well. So for ads to generate leads, that's what I want. But whenever I talk to them, I have to ask a lot of questions about how they're going to use it, how they want to access the money, when they want to access the money. The reason you wouldn't really want to use an IUL as infinite banking is because let's say you took $100,000 and you dumped it into an IUL. First of all, that's going to jack your death benefit up through the roof. Now the cost of insurance starts higher, and it's going to continue to rise with most IUL carriers along with the fees, right? So if you dumped in $100,000, it's going to be hard to keep up with that increase in cost of insurance. Also, with an IUL, you're only going to have access to around half of that money. So if you dumped in $100,000, you could access about 50%. When you put it into a participating whole life, you can access 90%. So you can put in $100,000 today, and you can go access $90,000 tomorrow once your account's set up. And you can use that to buy and flip houses, or buy real estate, buy a car, buy whatever, right? Anything I say, buy something that's going to produce you an income stream. Maybe it's a car wash, maybe it's vending machines, whatever you're into, right? So that's why this type of product is a little bit better for that. Also, it depends on their age and what they're contributing to their account. Just a general rule of thumb. People may disagree. This is just my kind of just general. This isn't a one size fits all. But typically, if they're under 50, I think an IUL is probably what I'm going to lean towards because it's going to perform a little better the younger you are. If you're 50 or older, yeah, an IUL can still be good, but this product is going to probably be better because you think about it, like Austin, you're a lot younger than me, right? I'm just guessing. I'm 46. You're 30?
31.
31. I was close. So whose cost of insurance, like Brendan, if you were writing us a policy, whose cost of insurance would be more? Me or him?
Yours. I
Mine.
mean, his because he's younger or whatever.
Yeah, he's got me, I've got him beat by 15 years. So my cost of insurance, my life insurance is going to cost more money. So with an infinite bank, with a participating whole life, the cost of insurance is level. Whatever age they sign up, it never goes up, unlike an IUL where it goes up all the time. So anyway, back to this. It's a dividend-paying whole life insurance policy issued from a mutual company. We'll talk about that more in just a second. And there's 2 qualifications to work with us at FFL. One, the carrier that we're using has to have been in business for over 100 years, and they have to have never once missed a dividend payment. So that means during the Great Depression, World War, tech bubble, 9/11, market crash, and even COVID-19, these companies never missed a single dividend payment. If you didn't miss a payment during the Great Depression, I can't call the dividend a guarantee. That's why I hammer in on this. Even with clients, I explain to them how this works and how the dividend works. Because this is not market-based. It's not performance-based like an IUL. It's based off of guarantees from the whole life, typically about 4%, and then it's based off of performance of the company. So how well they performed. So first of all, let's answer this question. Everybody asks, what is a dividend? A dividend is where an insurance company has basically made too much money and they have to pay that money back to somebody. So they're going to pay that money back either to a stock company or to a mutual company. So if it's a stock company like Transamerica, Aetna, AIG, Aflac, like we love those companies. But at the end of the year, their dividend goes to stockholders. So you don't have to have a policy with the company. You can just make money by owning stock in that company. So basically, they're owned by stockholders, which means their financial obligation is to make money for the stockholders. Versus with a mutual company, they're not publicly traded, which means they're owned by the policyholders, and their obligation is to make money for the policyholders. So here's a couple of stories that just I love. I won't share all these, but I'll tell you some quickies. Rockafeller, arguably one of the most famous people that made this, what it is. He called it the waterfall method, and people didn't really understand what that was until financial historians studied his spending habits and what he did. So he used a series of family trusts, and he would take out life insurance policies on everybody in the family, loan money out to, Cousin Josh when he wanted to start a business, put a policy on Cousin Josh so that when Cousin Josh died, he got his money back. And of course, after I think a couple years, they had to start making payments back into the family trust. It was all a series of life insurance policies. So if you want to look up the story of the Rockefellers, I think we're on generation 14 or 15, and they're still stupid rich to this day. Versus their neighbors, the Vanderbilts, which at one point had more money than them, they went broke after 4 generations because they used traditional banking methods. And when times got tough and they couldn't make their payments, guess who took all their stuff? The banks. So if you've ever been to North Carolina, go to the Biltmore Estate, yeah, they used to own that. That was the Vanderbilts. They don't own that anymore. So every president in history, whether you like them or not, have used some type of infinite banking. I don't get into politics, so whether you like Biden or not, he did fund his entire presidential campaign using an infinite bank. I don't know how much it costs to run a presidential campaign. I'm just guessing it's a lot of money. So the fact that it didn't really cost him anything because he used what I call OPM, other people's money. That's awesome. Doris Christopher, I doubt you know who she is, but she started a little company called Pampered Chef with a small loan from her life insurance policy. Today, that company is owned by Mr. Warren Buffett. Hopefully you all know who that is, and in your line of work, you should know that name. So the wisest, richest investor billionaire of our time owns Pampered Chef. I just think that's funny because he paid $900 million for it, for that company. Is that not crazy? Other than that, JCPenney saved his company during the Great Depression. He couldn't make payroll. He was going to have to lay off tons of employees. He went into his life insurance policy, took out a loan, kept his people paid, kept his company going. Ray Kroc founded McDonald's. Walt Disney, hopefully you know who Walt Disney is. I think everybody knows that name. So back in the 30s sometime, and you can fact check me, I'm sure I'm wrong on the year, but 1933, Walt already had Mickey Mouse. So he was already pretty famous. And he goes to the bank and he says, I have a great idea for a business. And the banker says, okay, well, let's hear it, Walt. What's the idea? And he said something. I wasn't there. But he said something like, I want to build a magical dream castle for toddlers. And they kicked him out. So you can look up the story. He got kicked out of either 8 or 9 banks. I can't remember, but he got kicked out of 9 banks. He goes to Big Brother and he's crying. My hopes and dreams are crushed. I can't start Disneyland, right? And Big Brother says, you do know that's what our life insurance policy is for. I mean, if you think about this, go back 200 years when they invented life insurance. They called it life insurance. I'm sure you've seen TikToks out there, mine included, where people say life insurance is not death insurance. That's something different, right? Life insurance was meant to be a vehicle to grow money, tax-free, tax code 7702, where you could dip into that money, tax-free, tax code 72E, and then use it for something. You can use it for whatever, tax-free. And then when you die, one of the features of this vehicle was that when you die, someone else is going to inherit that wealth. And that's tax code 107A, which is what you do every day, life insurance. This day, life insurance is the only way to transfer wealth from one person to another, tax and probate free. All those tax codes together protect life insurance from taxes. And yes, the government has actually tried to get rid of those laws and allow life insurance to be taxed multiple times. And they failed each time. For one, we don't have to get into the weeds here, but politically, there's a lot of big players in politics that use this, right? Like all of our presidents. So they don't want to be taxed either. So they're not going to let that happen. Let's see. Moving on. So here's a big question, and I ask all customers this. I try to educate them first because, see, you have to get their mind away from this being a bill. When they think of this as a bill, like when you pay your car payment, you don't get that money back, right? When you pay the electric bill, Wi-Fi bill, cell phone bill, like that sucks. You're just paying money for a service or a product. You're never getting that money back. So when they hear life insurance, they think the premium payment is a bill. And typically they're right, because death insurance, that's what it is. You're paying for a product or a service, and you don't get that money back. When you die, somebody's going to get that money back, but technically, right? But this is a lot different. They have to think of this as a bank account. This is a place to store and grow your money. So the question I ask people is, what do banks do with your money? And they say, well, they loan it to other people. Yes, they do that. And we'll get into that next. But before they loan it to other people, they actually invested in something called BOLI, B-O-L-I. That's called bank-owned life insurance. And if you go to my website, there is a list from the FDIC right here. You can use any of these articles. These are not my articles. I didn't write one of these. These are just links to articles like Forbes and Investopedia and Time and just different things that I like to use to show people. So look at this one right here. How much BOLI do banks own? If you click on that, here's a list. It's updated about every quarter, and this shows that 3,800 banks in America currently own right around $209 billion of life insurance. So, like, I have a Bank of America account. They own $24 billion of life insurance. I have a JP Morgan Chase account. They own $12.5 billion. I mean, look at all these numbers. You can scroll down through here for days and see how much money all of these companies, all these banks invest in life insurance as an asset. It even says it, as an asset. So why? Here's the question. Why are banks buying what we're selling? Because banks sell IRAs. So I know people think their 401k is their retirement plan. It's not. First of all, it's not a retirement plan. It is a tax code. The retirement plan is an IRA, right? So it's an IRA, and then the tax code telling you how the money is going to be taxed is the 401k, the 403b, the 457, the Roth, the TSP, all those things. So banks sell IRAs. Why aren't they investing their money in what they sell? Why are they investing their money in what we sell? It's pretty simple. And, I alluded to this on stage at convention, but I play the retirement game. Brendan, can I pick on you? I don't think you've seen this yet. Have you?
Feel free.
All right. If you get any of these 5 answers wrong, I'm going to kick you out of the training. All right. You can't come back. I'm kidding.
Well, get ready to kick me out.
No. You trust me. This is like kindergarten level, dude. You're going to get every one of these. You're going to nail it. All right. So you're going to pick your own retirement plan. And yes, I play this with clients. All right. So option A or option B, which retirement plan do you want? Do you want to earn 4% or do you want to earn 10%?
Well, I'm going to choose 10.
Good. All right. You're still in. Do you want to pay taxes or not?
No.
All right, very good. I like you already. Do you want to pay penalties every time you touch your money or no penalties?
No penalties.
Very good. Do you want to pay someone to manage your money or not pay anyone at all? No fees.
No fees.
All right, and then the last one is, do you want the ability to lose money every time the market crashes? Or do you want to guarantee that you can never lose money ever?
Guarantee never lose money.
So every single time, people pick this one instead of this one. This one is an IRA. This is your 401k, your 403b, your TSP, all those things. This one is some type of what we call LIRP, Life Insurance Retirement Planning, or if you like Doug Andrews, he calls it the laser fund, liquid assets safely earning returns. And now they're starting to call it the 501k. I think they did that just to make it sound like an upgrade. But so the 401k versus the 501k, but people get tricked into this one all the time. Because when we go to school, we're taught, listen, get in some massive student loan debt, go to a great college, get a good education, get out of college, get you a nice paying job that offers a 401k with a match, blah, 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 right? Which guarantees the federal government about a 30, 35-year guaranteed paycheck. And if you try to touch that money too soon, we're going to hit you with an extra 10%. So people get tricked into that all the time. Don't get me on the 401k rant. But anyway, that list is a good place to show people, like, this is where banks are putting their money. And they do that because they can put it in there tax-free. It grows tax-free. And just to be clear, what they do is they say, Austin, you're the new branch manager. We'd like to offer you a couple $1 million life insurance policy as a perk for working here, right? So what we're going to do is we're going to front load that full of cash. Now, as soon as they front load that with cash, let's say they put $1 million in it, they can then loan themselves from the cash value 90%. What's 90% of $1 million? $900,000. You want to know why banks have nicer furniture in their lobby than all of us combined do in our own homes? That's what they do with the money. And they know that they never have to pay that money back if they don't want to, and I'm going to show you why. So number two, what do banks do with your money after they have invested it in BOLI and earned, let's say, 9, 10, 11%? Then they actually can use fractional reserve banking, which is where they can loan your $1 to 10 different people at the same time. So here's a little illustration of this. So here's all of us putting all of our deposits in the bank. Then the bank, after they've invested it in BOLI, turns around and loans it out to people for houses and cars and everything else, and they earn about 500% return on investment. Then as a thank you, because let's face it, the bank didn't have any money until we put money in the bank. Once we deposited our paychecks, they're like, awesome, thanks, we can work with this. So we loaned the bank money. They invested it. They're making all this money, and then they give you back 0.01 to 0.06, usually 0.01 to 0.03, but my local bank gives me 0.06.
Essentially, they're using other people's money, which is our money, to build their bank.
Yeah, and then what's funny is you go asking if you can borrow some of that money you've been putting in the bank for all those years, and like, well, let's see if you qualify.
What?
Right. And you're like, it's my money. Like
I own the bank. What's up?
Yeah. Oh, anyway. Crazy. So what I'm showing people how to do is instead of using an actual bank, let's become our bank. Let's replace the bank with a dividend-paying whole life insurance policy, and you keep all that money in-house, right? So, I mean, if you think about it, going back to the whole a bill versus a bank account, when you hear me talk about these, especially with a client, several of you have been on calls with me, with your clients, you hear me ask, like, when I'm talking IUL, how much do you want to contribute? Right? Not how much in premium do you want to pay every month. When I'm talking about infinite banking, you hear me say, instead of how much do you want to pay in your, for premiums, you hear me call them deposits. How much do you want to deposit in the bank every month? So you can ask somebody the same question. Austin, how much do you want to pay for life insurance every month? Well, in your mind, you're going as little as I have to. But then if I say, Austin, how much do you want to deposit in your bank account every month? Oh, you see how that answer just changed? I didn't even have to answer that, right? It changed from as little as possible to as much as I possibly can. So they have to think of it as I'm putting money over here in the bank where I'm earning 10%. Otherwise, they're putting money over here in this bank. They're earning 10%. They're giving you back 0.01. Kind of a slap in the face. Over here, you're putting your money in the bank. You're earning 10%. You can loan it to yourself whenever you want. As a matter of fact, whenever you log into some of these carriers, it says take a loan. It doesn't say request. It doesn't say qualify. It says take a loan. So when you click take out a loan, it says, all right, you got $100,000 in here. You can access $90,000. How much of it do you want? You type in, I need $40,000 for whatever. They don't even ask questions. They don't care what it's for. It's your money. You don't have to have like, I'm buying a car and here's the interest and you don't need all that. It's your money. It's just like taking money out of your bank on your online banking portal. Same thing. And then they just know you a check. And then nowadays they're going to what's called auto bank transfer. So a lot of companies are doing that. All right, let's see. So just to kind of give you a visual, I think everybody here has probably bought a car at some point in their life. So there's 3 ways you can buy a car. You can finance a car, you can pay cash for the car, or you can use infinite banking. Most popular has got to be financing, right? And listen, we've all financed a car. I'm sure not everybody woke up and had cash sitting in their bank account and just went and bought their first car. So everybody's probably financed a car at some point in their life. When you finance a car, I like to think of it like this. So, think of it this way. You finance the car because you don't have the money for the car, which means you go in debt. Now, after you've had that car for 4 or 5 years, your car's got 100,000 miles. You're ready for a new car. Maybe it's got a couple dents and dings, whatever. So now what happens is you've paid the car off, but you need a new car. So you go back in debt. And then it's a never-ending cycle. You're just paying off a car, getting a new car. Now, some people drive it till the wheels literally fall off. That's great. But most people get a new car every few years, right? Every 5 years, every whatever. So that's why, especially where I live, I'm in the hills of eastern Kentucky, and a bunch of my buddies, they go, well, I pay cash. I ain't got a car payment. Yes, you did. You didn't wake up one day and have $35,000 to go buy your Jeep, right? You had to save money. So imagine this. The money you save that you put in your account is your car payment. Once you have saved enough money, now you use that cash and you go use it to buy your vehicle. Well, guess what? You got the vehicle, but now you don't have any cash. That's, again, a never-ending cycle. At least you're not paying finance charges, but you're just constantly buying a new car, and you do have a car payment because you are saving money in some type of an account. So there's really no difference in the two for you. You're not gaining any profit anywhere. If you look at the uninterrupted compounding interest curve, and does everybody understand uninterrupted compounding interest? So we talk about this a lot with IULs.
Elaborate on that a little bit.
Yeah. So let's say I wanted to buy, like the last car I bought, the blue Corvette. It was around $90,000 tax and everything. So if I had $100,000 cash and I wanted to go buy that car and I spent $90,000, I've got the car in my driveway, but how much do I have in my bank account? $10,000. So that's all that's physically in my account. Well, if I had a 401k and I loaned myself $90,000, also only earning interest, and we know according to Forbes and Investopedia, the 20-year average of a 401k is only 4.1%. So I'm only earning, let's say, 4.1% on the $10,000 that's still actually in my 401k. Versus whenever I use infinite banking, I don't actually ever lose any cash value. So if I had $100,000, I loan myself $90,000, I'm still earning interest on all of it, all $100,000, and I'm earning right around 10%. I'll teach you.
But let me ask you: do you still owe the $90,000 that you took out from your IBC?
It's a good question. It's a loan, and you're the bank, which means you get to dictate when, how, or even if that money ever gets paid back. You do want to pay it back. When you pay it back, they earn some interest. You know, the insurance company, they loaned you their money out of their general fund. So they loaned you money. Your money never moved. They're charging you usually about 4.5% interest, which means you're also earning interest when you pay yourself back. So when you pay your own loan back, you're technically earning a little bit of that interest as well. And you want to get paid off, because the sooner you pay off that loan, the sooner I pay off that $90,000 loan, I can use that exact same $90,000 and go buy something else. So imagine you run into a business owner that just, let's say, owns a restaurant. And you sit down and you ask them, Orlando, how much does it cost to run your restaurant? Like how much product, food, alcohol, whatever you have to buy in a month? And they say, it costs about $20,000. Right now, Orlando's taking $20,000 out of profits. He's buying product. He's cooking, fixing whatever product. He's selling it. He's making a profit. He's taking that money, putting it back in his account, and then he's spending money again next month. We can do the same thing with infinite banking, only we can reuse the same $20,000 every single month. He can take a loan. He can buy what he wants to buy. He fixes his food. He sells his food. He makes profit. He takes that $20,000 of the profit. He pays off the loan. He just earned interest. His money never left the account. So he was still earning interest all the time.
Wow. The reason I'm asking, because I used to be a banker, I used to work for the banks back in the days. This sounds more like it also sounds like a revolving line of credit where I can keep drawing from it, paying it back, drawing from it, paying it back. Now, let's say, God forbid, I pass away and I still owe that $90,000. They'll take that from the death benefit. Is that correct?
Exactly. Yes, it comes from the death
Boom.
benefit. So the death benefit is the collateral, because people always ask, how can you put, like Bradley has it. They did an interview on TikTok, and Bradley, the insurance guy, he goes, so you put $1 million in, you take $1 million out, how much do you have left? And Brad's like, 0. And he goes, no, you still got $1 million. And Bradley's like, what? Like, doesn't make any sense. That's exactly what we're talking about. Death benefit is the collateral for the loan. So when you use infinite banking, your uninterrupted compounding interest curve constantly grows up, which means if you look at real numbers, here's real numbers from, a couple of years ago on this Jeep. So $35,000 Jeep at 6%, which is a great rate if you can get that today, right? For 60 months, there's your payment. Total, you're paying $40,000, we'll call that $600. Subtract the two, you're paying $5,600 in finance charges. There's nothing wrong with that. I mean, like I said, we've all done it. I've done it. It's not a big deal. It's how most people buy cars. But if you learned this little trick, check this out. So instead of paying the bank $5,600, if you pull up a simple uninterrupted compounding interest calculator, you do the same math, $35,000 car. In this case, the interest rate is 5%. For 5 years, you make a profit of $4,000. So when you bought that $35,000 Jeep and you made those payments to yourself over a 5-year period, you made a profit of $4,000. It's not a get rich quick. I mean, you made less than $1,000 a year, but you didn't pay the bank any finance charges. You paid yourself the finance charges. Does that make sense? So you became the bank. You loaned the money.
This is amazing, dude.
And then you made money. Now imagine that's on a $35,000 car. I just bought a $90,000 vet. How much money am I going to make for paying off that loan to myself?
Quite a bit.
15, 20 grand. Do you have a question, Austin?
Yeah, one thing I just want to make sure I'm hearing you correctly on is we take the loan, the interest on that loan. I know the principal stays the same, earns interest at whatever the account's making. The interest on that loan goes to the insurance company because they took it from their general account, right?
So the interest on the loan goes, it's split. Think of it this way. You're making about 10%. So verified with Foresters that this is accurate in what I'm saying. So if they're charging you 4.5% for the interest and you're earning 10%, you're getting the difference. They're taking 4.5%. So if it, just to make it easy, if they're charging 5, they're making 5, you're making 5, everybody's happy.
So you're saying that dividends are paying 10%?
Dividends are not paying 10%. In total, you're getting 10%. So I said we'd cover that. So it's a good point. Thanks, Abby. So think of it this way. You're getting 4% on the guarantee of the whole life, like you get with just about every whole life policy. What you're getting in a dividend, and this is why it's very important, going back to one of the first slides, we only use companies that have been in business over 100 years and have never missed a payment. So the only two we have at the moment is Lafayette Life and Foresters. Both have an average dividend around 6%. It's like 5.7, 5.8. And Foresters has been in business 151 years. I know because I got this cup last year. So 151 years. In 151 years, their average is 5.9%. Which means, Austin, in your lifetime, unless Jesus comes back tomorrow, that's not going to change. 5.9% over 150 years. Yeah, Orlando, go ahead.
Sorry, and also very important, they're mutual companies, so they're not like private health companies. The policyholders own a little bit of that company.
Right, and that's how you get the dividend. If they were a traded company, a stock-owned company, then that dividend would be going to not you, the policyholder, it would be going to the stockholder. So that's how you're getting the 10%. You've got an average, I'm just rounding it to 6, so give me 0.01% here. So we got 6% from the dividend that we've not missed one in 150 years here, and then we got a 4% guarantee. Put those together, you got 6%. Be very careful how you word that. You can't guarantee 10%. You can guarantee 4, and you can explain how the dividend works, and that we use companies that have over 100 years of experience and have an average of around 6%.
I have a question.
Yeah.
Additional premium this year. Can I get loan next year?
You can get a loan immediately. You don't have to wait till next year. So if you put $100,000 in, as soon as your account's open, it usually, they say 30 days. All companies say 30 days just to be safe. Usually within a week, your account's open. You can log in. Like Orlando and I literally just helped a lady do this. So I'm going to show you that strategy that we use to help her as well in a second. But basically put in $40,000. She needed to take out like $14,000, $15,000 for her daughter's college. So it was what? It was maybe 4 days. We logged in, helped her create her account, showed her how to take out the loan. And she's
and it goes directly to her bank account as a direct deposit.
Yeah. So, I mean, she's got the money and she's paying off college. Now, her $14,000 never actually left her account. She can't loan it to herself again until it's paid off. Or if she has, she put 40 in, she has more she can loan. But that $14,000 is, let's say, is being used, right? So once you've maxed out, if I put 100 in, I loan myself 90. I can't take any more loans until the account's either generated more income or interest, or until I've paid some of that loan off, then I can reuse that same money. So you can also use this for income. So this is just, we're going to make one of these in a second, but this is just a little illustration showing you that this was a 30-year-old young lady, non-tobacco, and she wanted to buy that particular Jeep. So she was already doing a Roth, and her income level, max she could put into a Roth was $6,000 a year. So she's putting $6,000 a year into a Roth. So what she did was she said, well, this makes a lot more sense. Back to option A, option B, she was in option A, right? And option B was this. So she just said, you know what, my Roth isn't doing so well, so I'm going to take that $6,000, reallocate that, and open this account. And then she started it off with a $10,000 lump sum. So $6,000 a year, $10,000 lump sum. The cool thing is with this kind of policy, whatever you put in as a lump sum, you can put in every single year if you want. You don't have to, but you can if you want to. So, I mean, just think about that. If you had $100,000 you put into an IUL, you're still limited on how much extra you can put in year after year without making that policy. Modified endowment contract, making everything taxable. With this, if I put $100,000 in it this year, I can put in $100,000 next year, $100,000 next year, and that just supercharges my account. So if this little girl wanted to, she could put in $10,000 extra every single year. And what foresters would do is they would take a 5-year rolling average of, okay, how much did she put in average over a 5-year period? Now that's how much you can put in for the next 5 years, and then continue. Any more questions on this before we move on?
Yeah, with that, I assume these accounts MEC as well, if it's not done right.
They could, but our computer, just like an IUL, we check a box to where they can't MEC. So it's not going to let you MEC. In fact, if you sent in too much money, even with your IUL carriers, if you try to make a deposit and put in a bunch of money, we'll just send you a check back and say, hey, this is going to MEC if you do this. They're not going.
Question: Can you elaborate for those of you that don't know? Can you talk a little bit what MEC means?
Yeah, MEC is Modified Endowment Contract. So basically, that makes everything taxable because your policy has grown too fast based on the government guideline premium test, and now your policy has become an investment. You also have to be careful with the wording on that when you're talking about this on social media and to clients. You can't legally call this an investment. It's not an investment. And thank God it's not an investment. The word investment dictates that there's risk involved. These are guaranteed.
And taxes.
So whenever people hammer me, financial planners all day long on TikTok going, this isn't a real investment, I go, thank God, because,
it's not.
It's not risky. You're right. It's not. So somebody asked one day, what's the difference in a financial planner and what we do? We can technically be called a financial advisor. If you look up the difference, and I simply said, well, it's easy. We don't have a license to lose your money like they do.
Or not only that, we don't charge you fees to handle your money.
Exactly right.
We get paid by the insurance company, which is amazing.
Yep.
This is amazing, dude. I need to give me one of these.
In this scenario here, this girl's put in $16,000 year one, then she put in $6,000, $6,000, $6,000. On year 5, she had $37,000. So now she can go borrow that money and she can buy that Jeep. You could also turn on income streams, just like on a distribution on an IUL. You can do a distribution with this. You can just say, hey, I don't want to pay into this anymore. I want to start taking money. So we did an illustration here to basically show if she was 65, she had put in $220,000 over the course of her life, 10,000 lump, 6,000 every year. At age 65, she says, you know what? I don't want to pay anymore. I want to use this for retirement. And she's getting $22,000 a year back. So if she lived to be 90, that would be $563,000, which is a total tax-free profit of $343,000, which means she 2.5 times her ROI. And that's pretty impressive. Like I said, it's not get rich quick. It's not too good to be true. It's a very safe way to grow money. It's a banking alternative. Something else I always ask people is, would you rather have $1 million in a briefcase right now or a penny that doubles every day for 30 days? And you all know this is a trick question. Now, some clients, they know it's a trick question, so they answer it right. They just don't know why. But most people, I like to give them 2 seconds. I'm like, all right, Austin, I got a question. You got 2 seconds to answer. Would you rather have $1 million in a briefcase right now or a penny that doubles every day for 30 days? Go. And they go, $1 million. So if you chose the $1 million, here's what that looks like in a briefcase. It's not really that impressive, but that's $1 million in a briefcase. And if you look at what the penny does, it goes 2 pennies, 4 pennies, 8. You got $5 by day 10. You have $5,200 by day 20. And on day 30, it's $5.3 million. So just by not interrupting the compound interest cycle on these policies, that is how they grow exponentially. Even Einstein understood this when he said, compound interest is the 8th wonder of the world. He who understands it earns it. He who does not pays it. Sorry, I can't really do his accent, but that was pretty good. I've got a couple little other things, and you can download this whole slide deck, whatever we call these nowadays. I call it PowerPoint, but you can download this on the Alpha Team Facebook group. I've got it under files. I've added a couple things to it today, so I'm going to go update it. But there's a couple of articles here, and you can find these on my website also. We're talking with people that have a 401k specifically. This article came out, and it's talking about 401ks, and I love this. The cover of the magazine said, the ugly truth is the 401k is a lousy idea, a financial flop, a rotten repository of our retirement reserves. That's crazy. it was never intended to be a retirement plan. The man who invented it, well, not invented, the father of the 401ks, Ted Bennett, went on national television and said it was never supposed to be a retirement plan. It was supposed to be a supplement to pensions. What happened is companies saw that they could use it in place of a pension and get a lot of perks out of that. So it hurt a lot of people. Like if you read this article, this guy, he worked for 36 years for his company. He was going to get $1,400, wherever it is in here, $1,508 a month for his 36 years of work as a salaried employee at a chemical factory. And then they switched to a 401k at the last minute before he retired. Now he gets $225 a month. So he had to go back to work as a cart mechanic at the country club. That's crazy. I see these stories all the time. Anyway, there's all kinds of articles on here. You can click and read through those. I want to show you how one of these actually works real quick. Let's see. There we go.
So Shannon, I want to ask you a quick question to make sure I'm understanding this correctly. So you gave the example of $100,000. I have $100,000. That $100,000 deposited into my infinite banking. That is now, and then I take my money back out. That is currently earning, let's just say 4.55%, right? Or sorry, I pay a loan. Let's say I pay a loan of 4.5%, right?
Okay.
My own money, right?
Right.
Okay. And then but because it's the way that works is I'm borrowing their money, that money is technically earning, let's just say 5 or 6%, right?
Your money sits there and never stops earning interest. So the way
Correct.
Luke at Forrester's verbalizes that is that you're still sitting there earning your, let's say, 10% interest. And then the loan.
I understand where the 10% comes from.
Do what?
I'm trying to understand the 10%.
Okay, so the 10% is 4% of that comes from the guarantee of the whole life. Every whole life insurance earns cash value, usually around a rate of 4%. So theirs is 4%. That part we know is guaranteed. The rest comes from dividend, which is based, think of it like an IUL, comes from market gains, right? You're getting the index, you're getting the growth of the market, but none of the losses. This is kind of the same thing, only this is based off of company performance. So this company performs so well that they have a dividend, leftover profit that they've earned that they have to pay back. And that average over the last 151 years is right at 6%.
Okay. I guess the way I was thinking about it is that average included whatever their guaranteed is, plus some would make the complete average. But you're saying it's in addition to.
It is in addition to, yes.
Okay. Thank you.
So their actual average, if you want to throw in the guarantee, is like 9.8 or 9.9. I have to ask him to make sure I'm exactly right. But like I said, I round up to 10. It's a point off, half point or whatever. So this is the product that we use on this. Just say, we'll pick on Austin. You live in Texas, right? No, you live in.
I'm in North Carolina.
North Carolina, that's right. I met you in Texas, but you North Carolina. And I still pick New Mexico because I can't click apparently. There we go. You're always going to use this Advantage Plus 2 product. This is their participating whole life. Or you're going to change it to medical. So they have to have a paramed. Unlike an IUL, if it's face values less than $1 million or $2 million, depending on the carrier, you don't have to have a paramed unless something pops on your MIB or something like that. These always have to have a paramed. So put that in there. You said you're 31, Austin, right?
30.
Sorry, and I'm still making you older. That's why I pick on a guy, because I don't want Jessica slapping me because I was off by 6 months. Do it. So 30, non-tobacco, right?
No.
Benefit.
I don't.
I know what you meant. Death benefit and funding. So we're going to go to this death benefit tab. And one thing I love about Forrester's is, their software was not the easiest to use because you had to pick this solve, and then you had to go in and manually do math. And so anyway, I asked them if they could create this solve. I asked them to make it my name so I knew which one to click on because there's a lot of options. But anyway, they created this solve just for us, just because I asked them to. And it's made life a lot easier because the software is kind of witchcraft. I'm not going to lie. I'm not good with their software, but I can now get through it on my own. So click the last option right there, the base PUA percentage non-MEC solve. You pick how much they're going to put in a month. Now you could be pulling this from, for example, an annuity. So if somebody's putting in $50,000 a year, they don't have to put in $50,000 a year and pay $1,000 a month. people do that because that's, again, just another deposit. Some of that money's going to their account, some's covering the cost of insurance. But some people say, I just want to put in $50,000 a year, and I want my premium payments for the cost of insurance to come out of that, right? So we can do that too. But just for fun, let's just say $1,000 premium a month. I set this to 50-50. The way this has always been explained to me, and I learned most of this from Neil McMahon, my upline, and Scott Janod, who is our IBC director with the SRS team. Basically, you're paid on the base policy. The FPUA is their flexible paid up additions rider. So their PUA is their bank account. So I'm essentially taking a 50% pay cut, dumping it into their bank account to help it grow. So I'll leave this at 10, a term 10. So we want to add term insurance. Remember, we're paid on the base policy. Well, life insurance, whole life insurance is expensive, right? You can add term really cheap. And what we're trying to do is we're trying to get the death benefit higher so that we can put in more money and overfund the policy based off the government's guideline premium test. So $1,000 here, that's all you have to do on this screen. I know it looks confusing. There's a lot of buttons and gadgets, but all you have to do is pick the bottom solve, 50-50, put in how much you're paying per month. And there has to be some sort of correlation, like 12 times the base can't exceed 12 times the term. So I just know if I'm going to put in 50,000, I'm probably going to have to pay somewhere around $1,000. If I'm going to put in 100,000, I'm going to have to pay somewhere around 2,000. And again, that depends on their age. So I still get with Luke. I still have him run and help me look at illustrations to make sure they're tweaked exactly right. You know, because I mean, let's face it, we know like 40 different companies' software. We probably don't know all 40 companies' software as well as our internal carriers, our carrier reps know their own software. So I still send it to them and have them make sure it's done right, have them approve it, if you will. So once we have that done, we skip this one and we go straight to riders. Under riders, we're going to put in how much money we're putting in max for the year. So if the person's putting in, say, $50,000, that's the max they could put in on an annual basis. Then under annual lump sum, I'm going to add 50,000 here. And then I want to do that for usually years 1 to 1. In this case, I'm going to show you what happens if we do this years 1 through 4, just for fun. Don't touch anything else. Go to reports. Pretty easy. Unless this turns red and says mech right here, it'll turn red if it mechs, then you don't have to worry about any math or do anything. That's why that new solve is just amazing. So now you've got an illustration. Here's how this works. Hurry up and wait. All right, so first let's look at this page. This shows me where my money is going. I got a 30-year-old male, North Carolina. He's going to have a paramed. His face amount is $511,000. So when we look at his payment, if he was putting in $1,000 a month, it shows me that he has a basic life insurance, a whole life policy worth $511, and then he has common carrier, family health, all these different things, accelerated benefit. But here's the term rider. So we paid $55 a month to get him a $1.4 million term added on to the $500,000 base whole life. Then we have the flexible paid up additions rider. These also have a minimum payment. You can actually pay usually around half. So kind of like an IUL, you have flexible payments, you know, same thing here. So if something came up and they couldn't swing their premiums, you know, they could pay much less and still keep their plan. Just like an IUL, you're going to go to tabular details with most carriers anyway. And here's what we're looking at. So Austin put in $56,000 year 1. That was his change. I guess it reduced it to $500 a month. I put in 1,000, didn't I? That's weird. I told you their software is witchcraft. So hey, if it works with 500, great. I was just guessing 1,000. So anyway, this is $500 a month total initial premium. So I have $5,600 going in. This shows me the amount of money that you can borrow, that you can access. That's the 90% that you can access of your money. If you don't put in a lump sum, you have to wait until a year, right? Whenever that's generated some cash value. But in this case, we dumped in 50, so we can borrow most of it right away. And here's the death benefit. So let's go back to Orlando's question. Orlando said, what if I borrowed, let's just say, forget the interest. Let's just say he borrowed $100,000 year two and he went and bought a $100,000 car. Let's say that Orlando dies, say 5 years later, something crazy happens. He couldn't drive. He wrecks. I'll put any bad juju on you, Orlando. But so 5 years later, something happens. He crashes his car. He's supposed to have a $3 million death benefit. What they're going to do is they're going to mail his wife a check and a letter explaining why she only got $2.9 million because he took out a $100,000 loan and he never made a payment on it. So they're going to deduct it from the death benefit. This is collateral on your loan. That's the hardest concept for people to grasp. They don't understand how they can put $100 in, take $90,000 out, and they still have $100,000 sitting there in their bank account. Because that loan came from Forrester's Financial, from their general fund. They loaned you their money. They know they're going to get their money one day. Why? How do they know that? What's the percentage of death in our country? It's 100. Everybody dies. Even Jesus died. He rose again on the third day, but he did die. So everybody's going to die. So they know that no matter what, they're going to get their money at some point. Like I said, you want to make payments. You want to get that paid off soon, but let's go down here to when Austin is, here's age, when he's like, let's say, 85 years old, and he kicks the bucket. We use 80 just for fun because it's already totaled, and I don't want to do math in my head. So Austin's put in $473,000. Austin has almost $2 million in the bank and a $2.7 million death benefit. Now, just like an IUL, I don't care what anybody tells you. Show them my video, tell them to call me, and we'll duke this out. You never get both of these. You do not get both of these. Now, technically, if you do an IUL and you set it up the correct way for cash growth, which is increasing, you do get both of these. You get the cash value and the death benefit. But this number right here already includes the cash value. So whatever an IUL says, whatever this number is on the death benefit, that's all they're going to get when somebody dies. Same here. So use the money. Don't let it sit here for a rainy day. Use this money. That's what it's there for. It's your bank account. So my rule is I keep enough money in the bank to pay my basic bills, and then I have this account, which is earning 10% at all times. When I want to make a purchase over $1,000, I buy it out of this account. Dishwasher, buy it out of this account. Car, flip a house, whatever. I use this account. So one last thing, really quick. Here's a strategy that a couple of you guys have asked about, and this is what I do. So I showed you how to put $50,000 in this policy for 4 years. So how do you find that $50,000? One, you're already talking to these people, right? You're just going to ask all your clients, what do you have that acts like life insurance? And, then you hesitate for a second. You say, like stocks, bonds, mutual funds, 401k, TSP, Roth, like where do you have money so that if somebody in your family were to pass away tomorrow and you had to go pull 10 grand, you could pull that $10,000. Where do you have that? And if they have it, they'll tell you where it is. If they don't have it, that's fine. Not everybody does. So if I find it, I'm going to use the case Orlando and I just on. So he had $500,000 in a TSP, which is essentially a thrift savings plan. It's what's called a 401k for military. So 32658. So we take that $500,000. We can't roll that into life insurance because one is qualified funds and one is non-qualified. One's taxable, one's not taxable. We can't roll those. There's not a way for us to do it, and it's illegal. It's called commingling funds. It can't be done. What to do first is secure that money into an annuity. So here's what I'm going to do. We're going to set this up real quick. We can leave it Kentucky. It doesn't matter. I'm going to use Performance Elite Plus, where they get the bonus. They get a larger bonus. So he's 30 years old, male, qualified money we're putting in from his 401k, for example. We're putting in $500,000. I'm going to do a 15-year annuity, and I'm going to set the strategy preset to growth. For withdrawal, I'm going to do a free withdrawal percentage, which is 10% immediately. By using the Elite Plus, you have access to 10% day one, and then years 1 through 4, we're going to do free withdrawal and see what it is. Or I could just say specify an actual number, but I just want to kind of see what this will do.
Is that taxable when you withdraw?
So it depends on how the money came in. In this case, it came from a 401k, so yes, it's still taxable. If your money is already taxable, you're never going to outrun the tax man. But it's a little better because you're taking small quantities of your money at a time, not one big old tax hit. So very good question. So when we look at the illustration here, we put in 500,000. We got a 20% bonus, which is 100 grand. Thanks for doing business with me, Austin. We're going to put $100,000 in your account day one. Have you ever earned that kind of interest day one? Here's what we're looking at. If I pull 10%, that means I have access to roughly $60,000 each year. I only need 50 of it. So that's where I'm pulling my 50,000 from, right? So in this case, I didn't really even cost the customer anything. I found their 401k. I rolled it here. We pulled 10% out for a few years, and we fed it into the Infinite Bank, and that's how we started their bank account. So let's go down to when he is 80 again. I think is when we said, Austin, you're going to kick the bucket. Sorry about that. So at age 80, he has now withdrawn almost $6 million out of his, sorry, that's RMD's cumulative withdrawals. By age 80, $32 million. He put in $500,000. $32 million, and his death benefit he can leave behind is $121 million. Now that's mind-boggling. That's hard to wrap your head around and get a customer to go, what? But that's their illustration. So, and over here, he had another, what, couple $1 million in cash and a couple million in death benefit. Questions?
Yeah, I got one. I taking money out of this, like for this example, would I be taking money out of this account at a certain age until death? Like, I didn't see that anywhere on the report.
So the cool thing with the annuity, you could take 10% each year. When it annuitizes in this case 15 years, you can take all that money out and do something with it. So 67, so like here, right here, you would have roughly 51 million. You could, if the account's performing well, a lot of people just leave it in there. They just let it keep working, and they still have access to money. So at that point, you have access to all your money. You got $51 million sitting in there. You can do whatever you want with it. You want to pull it all out, reinvest it, buy something with it. That's up to you. If you want to leave it in and let it keep growing, when you hit 75 in your case, they're going to make you, RMDs are required minimum distributions. They're going to make you start taking out withdrawals. So they're going to force you to take out $4 million in this example. It's a good problem to have. Okay. But that is how I find the high AP on this with these accounts. So I find the annuity opportunity, and then if they want to use it like a bank, the annuity is great. You could stop right here, especially if they had health issues, right? There's no health questions on the annuity. You could stop right there and they're good. Or they can take some of that money like we did here, and they can withdraw that from here, and they can pay for an Infinite Bank or fund an Infinite Bank, deposit that into a bank, and then they have access to use all of this money right here. So this is what they would buy things with.